World Financial Group offers entrepreneurs from all backgrounds the opportunity to start their own business on a level playing field. Dr. Yana Woodhouse, receiving the WCM Wall Street Pioneer Award by the United Black Wall Street of America, Inc., is one of those entrepreneurs.
I see WFG and TFA as a place where African Americans with an entrepreneurial mindset can flourish. And the bonus, we help families and serve the communities across the country.
To learn more about us, go to worldfinancialgroup.com.
We are the sons and daughters of the soul. We are resilient and forever forward-thinking. We ask for nothing else than the opportunity to live and to create the lives that we were meant to live. We want nothing but an equal chance at options and possibilities. The same possibilities and options to live out our potential as our fellow man. We want to be heard, understood, and expressive in our reality. We are the future. We are the creative. We are here.
She was told that she couldn't play with the boys. She was told that they were too big, too rough, too strong. She was told to give up her dreams and move on. She was told to just be pretty, be quiet, be a lady. She was told that women had to stay on their side of the court, stay in your lane. Playing and competing with men was insane. She was told that men and women would never be equal. Dreaming like that would only be linked to your mind, to your soul. She never listened. She knew that their thinking was old. She is magic. She is the definition of spirit. She is what champions are made of. She is now.
Greetings and welcome to Access Wealth Nation with Dr. Yana B. Woodhouse on the Soul City Network. And of course, broadcast through WHCR 90.3 FM, the voice of Harlem. Here we're giving you that checkup from the neck up and building your financial literacy. Change your financial literacy, you'll change your life. And so today we're going to cover some more aspects to taxes since this week is the beginning of tax filings. And so I'm going to cover a few things that your preparer or your accountant should be asking you. If not, at least you should be addressing it to make sure that they're asked. Of course, before we get started, you can get the How Money Works, Stop Being a Sucker book. And you can do that by going to wealthwave.com/Yana B. Woodhouse. It's really changed a bit. Just a little check. It's wealthwave.com/ I had to cut it down a bit, so it's just Yana B, because people for some reason couldn't spell the Woodhouse. And so it was getting kicked back. So that's a minor correction. But if you go to wealthwave.com/ Yana B, you can just scroll down and order the book. The book is free. And also while you're on that page, take a look and see what you can learn. The literacy, financial literacy is so important because if you know better, there's a good chance you'll do better. So definitely the book is the kickoff to get you started. In addition to it, if you'd like a free financial review or analysis where you are financially and where you'd like to be, if you'd like that free analysis, all you have to do is contact my office at 646-375-2121 and let us know that you have heard the show and that you'd like a free financial analysis. The better is to read the book. Read the book. And by reading the book, you have the opportunity to have a foundation so we're able to get you to the next level. So if you are looking for any other type of assistance or maybe have a group that you would like to present a financial literacy seminar, again, I'm available, and also my staff, to do seminars, financial literacy seminars. And that you just have to give a call to 646-375-2121 and let us know you have a group and you'd like, so long as you're providing the audience and the place, we'll be glad to come and bring the information and the knowledge. So today, like I said, since it's a situation of where IRS has opened up finally, and you need to know some aspects of what you need to do to get your taxes kicking. So we're going to cover just some major things. But before I get started, I want to make one thing and emphasize one thing. And that is, a refund is just what I said. It's a refund. Means you gave the people too much money, but you gave the IRS too much money, and they gave it back with no interest. Who does that? That's not something that you should be focusing in on. But in our communities, that's the big thing everybody talks about, even to the extent that sometimes people borrow other people's children. It's just not the way that we should be thinking about growing our legacies and building our finances. So today we're going to cover a few of the major elements. We're going to get started with talking about truly retirement information. You should always speak to your accountant or preparer to let them know whether you've retired or not, and what kind of activity do you have available. If you're working on a job, you should also let them know whether you are involved in a pension or if you're involved in any retirement plans. The other thing is that you need to talk to your preparer and always let them know if you received any Social Security benefits during the year. Why is this important? There's a good chance that Social Security income is going to be taxable. There's a little formula to determine it, which they'll be able to do. But if you don't tell them that you got Social Security benefits, it could cause a great problem. Not your first year, not the second, the third year. All of a sudden, IRS starts to come knocking on your door with interest and penalties because you didn't tell that you received any benefits. It can be disability benefits or general SSA, but you need to let them know, let that be a determination of whether or not you have to pay taxes. So, were any withdrawals made from your IRA, your Roth, your Keogh? Keoghs are so old. I don't think there's only a few out there now. Simple retirement, SEP, 401k, 403b, tax thrift savings. All of these sound like something. You need to know whether you made a withdrawal. If you're under 59 and a half, this might be as a withdrawal taxable. And if you're over 59 and a half, it may need to be added to your income. And when I say under 59 and a half, I left out a key. You may have to pay a penalty, 10%. So it's not just the 10%, but it's 10% plus your tax bracket. So you've got to be very careful with this. And if you did make a withdrawal, like sometimes you make a withdrawal from your retirement plan, and you planned on paying it back, but time passed and you didn't, then you need to know, did you make this withdrawal due to a federally declared disaster? You know, when we hear those, like a few weeks ago, we had in San Diego, major rain coming down, or fires, all these things. If the government declares, the federal government declares it a disaster, you may get a waiver, but you need to tell and say this is what happened. If you received any qualified disaster retirement plan distribution, did you repay it at any point of 2023? Because if you repaid it, it probably won't be taxable. But if you don't tell it, nobody is a mind reader. So you've got to be able to do this, to tell everything that you've done. I give my clients a checklist because many times we forget. You did something January, and here we are in the next year, January. We don't remember that we did it. Okay, did you make any contributions to a retirement plan? Now, if it's on your W-2 form, we should be able to see it. But if you're self-employed, then you need to let us know. And if not, but have an opportunity to do a contribution, that might save you from paying on your taxes. Here's some education information. Did you have any educational expenses during the year on behalf of yourself, your spouse, or a dependent? Now, if the person is still in college or in college and was more than a half-time student, there may even be a credit there. The other questions that should be asked is, did anyone in your family receive a scholarship of any kind during the year? Very serious situation. On your 1099-T, as in Tom, it should state whether there is a scholarship involved. Some scholarships are taxable, some are not. Some will affect whether you're going to get an educational credit or not. So information is so important. It's almost like when you talk to your doctor, you need to give all the information so they can make a decision on what to do. If you withhold, it can make a difference in your health. The same thing happens when it comes to your taxes. If you don't tell your accountant everything, it can make a difference in the long run. Did you make any withdrawals from an educational savings, a 529 plan, or did you make a contribution? Some contributions will be tax deductible. If you made a withdrawal, you need to fill out a form to let it know, where did the money go? Did it go for the child's education? Because now you can do a 529 plan and you can use it for kindergarten all the way up to grad school. So it's very important that you share this information. Now, not everybody, but in some cases, if you paid student loan and you fall within what we call the inflation brackets, you may have a deduction there also. That might be an easy deduction to help you bring down your taxable income. And did you cash in? Because we're at that stage. And anything after 1989, did you have any Series EE bonds? Back in the days, it was one of those really good ways that people saved for college education or to save for their children's inheritance and their future and legacy. But if you cashed in the bank, the bank should have given you a slip to let you know what the interest differentiation was. And then also, would you like a worksheet to aid in completing the free application of federal student aid, FAFSA? This is the time when most students need to fill out the FAFSA form. And so it's always good to find out if you need assistance in filling out the FAFSA form. Healthcare information. Now, a lot of people think that out of the pocket expenses is going to be deductible. It has to come over 7.5% of your adjusted gross income. What's your adjusted gross income? These are your wages, if you got a pension, and some other things that you have to come over 7.5%. If not, it isn't deductible. But don't let you make that decision. Make sure you give that information so that it can be figured out by your accountant. Did you make any contributions to what's called an HSA or an MSA? These are health plans that are prepaid plans. You're putting in, you get to deduct it from your income because you're going to spend the money anyway. So it's good that it can come before taxes. But did you use it? because a lot of the plans after a certain period, if you don't use it, you either lose it or you wind up paying taxes on it. Okay. And did you pay, which is something that's really focused on right now because we have all these baby boomers turning 65. Did you pay long-term care premiums for yourself or your family? If you did, that might, and I did say might, these are all might be a situation of where you have a deduction. Just like if you're a business owner, and especially with the new tax laws for this year, did you pay health insurance premiums for your employees this year? If so, that can be a major deduction in your business. Now let's take a quick look at itemized deductions. Not everybody's going to qualify for itemized deductions since the changes were made on the tax laws. It is now that you get a standard deduction and you're able to just take that without any proof whatsoever. Just it's standard. But in some cases, we do major contributions and non-cash contributions. Did you take any of those? Did you get a receipt? If you have cash contributions to churches and charities, make sure you get a receipt. It should come at the end during the end of January or the beginning of weeks in February, showing what did you contribute and provide that. If you do non-cash contributions, let me give you a hint of what that's like. You should have already done it by December 31st, but that's clothing, furniture, household items. These things are non-cash contributions. You have to file an itemized list of what you gave if it's over $500. So if you give to Goodwill, I suggest Goodwill, Salvation Army, St. Mary's, all those things. Make a list of what you put in the bag. I put 3 shirts, 4 pairs of pants. I had a blender, all those things. And then the accountant can take that list and make an estimate of cost of what the market value is right now. And that can be part and part of your, but it's on a special form, which means when you have a form, an extra form in preparing your tax returns, usually there's a cost to that form. Okay. Because if it helps you to make a deduction, that's a specialty that you may have to pay a little extra on the preparation. Were you any interest expenses or property taxes paid during the year? That should be on your 1098 form, and it should show. It usually shows what your mortgage payments, how much that should be, how much you now owe on the house, a home, condo, and then also the mortgage interest and the property tax. Those things should be listed. Now, there's some restrictions to this. What are the restrictions? Is that for the mortgage interest, if the home you might have just purchased, if it's over $750,000, there's going to be a prorated amount for your mortgage interest deduction. If it's under, don't worry about it. You get the mortgage interest. Then you have the property tax, real estate property tax, with your withholding from your state and local altogether cannot be more than $10,000. So that, again, don't make those mistakes, especially if you're starting to do a return by hand. Best thing is not to do a return by hand. Make sure you use some kind of software and then it gets double checked. Were any gifts of $17,000 or more given during the year per person, not total? So you could give a gift to your children, your grandchildren, your nieces and nephews, and it totals $17,000 or more, no gift tax. But if you gave more than $17,000 to each person, there may be an aspect of gift tax. and it has to be filed. So you need to tell. So if got a lot of income, came to a windfall, you have to be careful whether or not you would be subjected to gift tax. Also, did you incur a casualty of theft during the year? This has to come over a lot. It has to come over 10% of your adjusted gross income plus $100 to see if it's even deducted. And in some cases, again, here comes that national federal disaster. Be careful. So there's real estate tax and mortgage interest on 2 homes. That's another calculation, and depending upon whether the secondary home is a rental income property, this is when you got to dig deep to find out what qualifies and what are you eligible to deduct. Did you incur interest expenses on any investment accounts? And I'll bring in there also is the element of cryptocurrency or virtual currency. You need to keep up. If you bought virtual currency, you've got to be able to know the date and the amount that you paid for it. And if you sold it, how much did you sell it for and when did you sell it? Did you have it for a year or more or less than a year? These are important because they're tax different between a short-term gain and a long-term gain. And again, here we go. Did you make any major purchases during the year, like a car or a boat? And then we need to know, are there any energy credits that may come with it? Did you pay more in tax, sales tax on these large items? Did you make any out-of-state purchases? Now, this is really something serious with people who buy out of state and possibly buy on the internet. You have to know, did the seller collect any state sales tax or use tax? So you need to know this because that's one I know, especially not here in New York, but in New Jersey, that's a big issue. And a lot of states count the use tax. Okay. What should you know about the 1099s? All 1099 forms serve the same purpose. They are used by the taxpayers to provide information to IRS. So when you make interest in the bank, if it's over $10, that information is sent to the IRS. The same thing for if you receive dividends from an investment. Did you receive any money that someone paid you for doing some work for you? It's usually on a 1099. And there's different types of 1099s. But for IRS, they compare it to the income on your 1040 against the income that was reported on your 1099 form. It's better to pay the taxes and calculate it than to wait until they tell you that you received the income. And that can cause a lot more penalties and interest. You don't want to do that. Payers that pay to a 1099 are mandated to do it and pay by, which is already passed, January 31st, 2024. This is one of those things that you have to be aware of, that if you get a 1099, especially those who have done Zelle, PayPal, Cash App, any of those entities, you're going to get a 1099K, K as in king. If you get it and you only received money from family members, they were helping you out, that is not taxable. But if you got it for selling an item or doing some work or buying and selling on the, on the internet, like eBay and like that, those things are going to be reported. So you might as well deal with it. Now, when you get the 1099, you are allowed to write the expenses that it took to get that money. So if you did a job, it would be some elements of, did you have tools? Did you have to use the internet, your cell phone, all these things to get this money? If it's a case of where you're not sure whether you had to pay to add to your income or not, because it could be just regular income and no deductions at all, let that be the decision of the professional. And this is the discussion of the 1099K for 2023. The third-party settlement organizations, like I mentioned, they have to report on the 1099K anything over $600, regardless of how many transactions. So watch for IRS's changes at the end of the year. Okay. What do you do if you receive a 1099K and it's an error? Contact the issuer and let them know that this was just family members sharing money and it was not a transaction. If you cannot get a corrected form, then you need to basically put it towards your assets, the personal assets that were sold at a loss, show that. Or if it was a gain, show that. But there are places where you're eligible to show that it was in error. Okay. Now let's see, our last little bit here is that what do you have in common, most common in 1099s? We have the 1099 DIV, which is dividend. That's from stock and mutual funds that pay dividends. Sometimes it's little, sometimes it can be a lot, but you have to add it in because they will be reported. 1099 INT, that's from interest from a checking, savings, or other bank accounts that earn interest. Now there's something called a 1099 miscellaneous. This is payments of $600 or more on that a business pays, maybe for rent, or it may be where with the miscellaneous it may report of $10 or more to pay for royalties. You know, some of you are actors, actresses, repetitive income. Other income not subjected to self-employment tax. Okay, so this is very important here. It used to be where everything was a 1099 miscellaneous. It's not, because they separate them. So it's only for things that are not subjected to self-employment tax. Self-employment tax is when you work for yourself and you've got to pay taxes on that income. And the way that it's figured is you have to pay Social Security and Medicare tax. Then you have the 1099-R. Now what that is that's when you take money out of a pension, annuity, retirement account, profit sharing, IRAs, maybe on an insurance contract if it's matured. You might get a 1099-R and it has to be reported and then discerned whether there's taxes needed to be paid on it. On the distribution, it's first in, last out. So the first money that comes out is the growth that took place. And then first in, that's the principal that you put in. How much did you already pay taxes on? Again, this is when you know you need to pull in a professional because stuff is happening. Okay. Then there's the most common type, which is the 1099 NEC. And the NEC stands for non-employee compensation. This is used to report payments made that are, of course, in excess of $600. Don't know how they got to that $600. In the course of a trade business to a person who is not an employee. So sometimes it's business to business, but you don't have to really file one of these, the NEC, if it's business to business. But let's say, for example, you help someone on a job, or we do all these giggings, gig economy. It may be that someone paid you to walk their dog and they decided to produce the 1099 NEC. This, then they would ask for your social security number. They would provide this, and they would have already done this, but sometimes people are late in doing the 1099s. So you want to make sure that any income that you receive during the year is accounted for. So let's look at some of the deductions as we go through. Deductions and other considerations. Medical bills, like I said, is medical bills not just for you, but your children or even your adult parents that you take care of can be part of the deduction. There's an education credit. If you do not claim the dependent, you cannot claim the education credit, even if you paid the bill. This is important. It is important with children starting to claim themselves when in college. If you can't claim them, you can't take the education deduction. Child and dependent care tax credit. Both parents can claim this credit even if they file separate with any status of work related expenses incurred for the care of a child under the age of 13. This also deals with away camps and after school programs, but that's what they need to be, is not the regular education. I've had folks time and time come to me and say that they wanted to deduct their private school tuition. That's a luxury. That's what IRS considers a luxury. So don't even think about it. It's not a deduction. It is, but you can use your 529 plans for that. Just to get an idea of the change that took place in 2022, the standard deduction for a single person was $12,950. And today for 2023, it's $13,850. So there's some growth that takes some deductions and increase in deductions. And it's different for head of household and also for married filing separate. Alrighty, so we're rounding around here is that tax consideration for retirement. When you retire, your income typically flows from three sources. One is Social Security, the distribution from retirement accounts like your IRA, your 401k, your thrift savings plan, your 403b, these are all the things, and funds from savings or other investments. Depending on your income level, you may want to use certain tax strategies. And here's a few to consider. Live in a tax-free state. Did you know that there are tax-free states? That you got to go look for them. I'm getting ready to tell you where they're at. But there are some tax-free states that if you retire in, they are retirement friendly, because some states are not retirement. They tax. Now, the thing is, if you live in New York and you are a state or city employee, your pension has already been paid for the state. You do not have to pay taxes on it. But if you move to another state, not New York, then you have to pay taxes many times on that pension. Be very careful. Also, what we got here in New York, we call our snowbirds. Our snowbirds mean they live half time in New York and half maybe in a state that doesn't have state tax, like Florida. That's normal. So if that's the case, then you pay part of the taxes you don't have to pay anything in New York, but you do, and you don't have to pay in a tax-free state. But if you move to someplace like North Carolina or South Carolina, you're going to have to pay taxes on that portion of your pension. Then you got to reassess your investments. Sometimes you got to look to see, should I be in some things that are tax free or tax advantage? Do I need to take everything now out? This is when you call your financial advisor and get an analysis done so that to make sure that you're doing the best thing as far as your investments are concerned. And be strategic about Social Security. Most people, I don't know why. Yes, I do. They just want their money. They're like, suppose I don't live to be 68. Suppose, I want my money at 62. You have to be very careful here, because if you earn more than 19,005 off of a job, that Social Security is going to be reduced. So you have to be strategic about Social Security. Also, if you're a high pension earner and you're taking Social Security, that Social Security payment could be up to 85% of it being taxable. That's an ouch. That can hurt. So you want to be careful when you're sitting, and that's why it's so important if you can sit with a financial advisor or someone who can help you to look at these things. If not, you've got to look at them, because in the long run, it can really cost you. You receive your Social Security money, you reach that ripe age that you can get the maximum, but then you don't take any tax out while you're working. Very dangerous. So because you have to pay all of that in one lump sum, or you're going to have to do payment plans, and that can be costly with interest. Now you got your retirement money, it's a little extra money in your pocket, and now you got to give it back to the government. Don't let yourself be in that kind of situation. Now, tax consideration for retirement. You may want to live in a tax-friendly state. I mentioned it. So in some states, you get an exclusion from of course, the $10,000 real estate, state income tax. Sales tax can be deducted from your federal taxes. And that reached each year up until 2025. Then they're supposed to be changing. We don't know what's going to happen. I'm hoping that we get back the maximum, because we have people in Long Island and in parts of upstate New York that pay a very high real estate tax, and they don't get the benefit behind it. And so it's great if we can get that. But right now, through 2025, you are in a position of where you have up to $10,000 deduction on your local property, state and local income tax, and your sales tax to be deducted from the federal. That's if you itemize. Now we're winding down. Now we're going to have a little short session here, and I'm going to close out with some different types of ideas that you got to think of when you say you want to be and live in a tax-friendly state. There are 8 states that have no income tax, no state income tax. You've got Alaska, Florida, Nevada, South Dakota. Here we go to the cold states again. Tennessee, Texas, Washington State, not Washington, D.C. There's taxes in Washington, D.C. and Wyoming. Now, New Hampshire taxes only interest and dividends. So if you're looking to relocate, especially in New York, and you didn't work for a state or local government, and you're looking so that your pension will not be taxed or your retirement money will not, because you don't have a state tax, these are the areas that you should be looking at. Last one's kind of cold. Florida. Okay, everybody, that's like little New York. Nevada. There goes Las Vegas or Henderson, Nevada. South Dakota, that's cold. Okay, Tennessee, Texas, Washington State, and Wyoming. And of course, unless you have a lot of investments where you have interest and dividends, that you will be taxed on that. So I'm hoping that this was informative to you and to help you prepare. Again, if you see that you have every year that you owe the government, you may want to do what's called estimated tax. The first estimated tax is due April the 15th, just like the ending of your tax return preparation. And then every quarter thereafter, so that's June, September, and then to really it's January, they give you on the fourth quarter. So you want to make sure that you prepare and make your life with taxes simple. There's only two things guaranteed, that's death and taxes. And we have had a lot of situations that have occurred in our country, and taxes have gone up, even though we've had the standard deduction, which has helped because that lowered the audits because you didn't have to worry about them asking for receipts. But the key is that you want to sit and work on your taxes or work with someone and pay somebody to do it. Your taxes here in New York, we have, of course, our government in New York has allowed us to deduct things like on the state side, our uniforms, our union dues, our investment expenses. Those are some of the things that will be deductible, plus tax preparer fees. That is not so on the federal government side. So don't go there with all of this thinking you're going to get all these deductions on the federal side, but it may help you on your state. So I'm hoping that you learned something. If you have questions or you need a consultation on taxes, you can dial 646-375-2121. And my office would be glad to help you and set up an appointment for a consultation. If you need your taxes prepared, our offices do provide that service also. That's Anaj Enterprises. But for the most part, the key is to pay attention to the tax laws. Get your taxes in early. Early is the best because late can cause you, when you get that bill at the end, I had people come today and the beginning of the week, and all during this week we saw where they ended up owing that they didn't expect. So it's better to find out early and then be able to give yourself a couple of months to pull the money together or make an agreement to be able to pay periodically, make a payment plan. So this is Dr. Yana B. Woodhouse with Access Wealth Nation, giving you that checkup from the neck up. Hope you really did learn something today and pay attention and watch this again if you need to so that you understand some of the things you're eligible for. This is the second version. The first version was last week. And so we are so happy to serve you. And again, if you go to wealthwave.com/Yana B, that's JANAB, then you can also get the book, How Money Works, Stop Being a Sucker. So it's my pleasure, and I'll see you next week as we do every Thursday at 6 p.m.
She was told that she couldn't play with the boys. She was told that they were too big, too rough, too strong. She was told to give up her dreams and move on. She was told to just be pretty, be quiet, be a lady. She was told that women had to stay on their side of the court, stay in your lane. Playing and competing with men was insane. She was told that men and women would never be equal. Dreaming like that would only be linked to your mind, to your soul. She never listened. she knew that their thinking was old. She is magic. She is the definition of spirit. She is what champions are made of. She is magic.